we've noticed rates, especially the Bank of England rate, has actually increased significantly from a few years back. Now, has that had an impact on what you've seen in the market? So this could be in terms of the type of developments that are being undertaken, and also with people struggling to exit bridging finance. Now, bridging loans to me are like credit cards. If you use it in the right way, it can actually be very profitable. It can actually help you in your journey, and obviously if you don't use it in the right way, it can be very costly and a very expensive mistake. Now, today we're actually joined by Justin Cooper, who's a senior BDM at Octane Capital. We know Octane actually pretty well. We've been working with them since they established in 2017. They've been going for just over 8 years now. I'm just going to welcome Justin. Thank you for being here.
Hello.
You're quite an experienced BDM. Do you want to give us a breakdown of your background and experience?
Yeah, sure. Yeah. So I've worked at Octane since it started 8 years ago. Prior to that, I worked with the founders of Octane, a previous company called Dragonfly. That was for another 5 years. And so all in all, I've been in the bridging industry now for 13 years. Lent quite a bit, probably been responsible for probably just over £1 billion worth of borrowing over that period. So it's been a busy time, ranging from small bridging loans up to, 8-figure development exit loans. It's been an exciting time, but more than anything, good company to work with.
No, definitely. Now, for those that don't know, can you actually break down what a bridging loan is and the purpose of it?
Yeah, sure. Well, almost by the nature of the name, the bridging loan is really finance that is designed to get you from A to B. And it might be that a property that you wish to purchase is not suitably habitable, where it's not possible to get a proper long-term mortgage on that property for one reason or another. So a bridging loan is short-term finance that is not designed to be held for long periods of time. The pricing would suggest that it's not something that you want to hang on to for multiple months or multiple years, but it's designed to allow you to make the necessary changes that a property may require to take it from non-mortgageable situation to a mortgageable situation.
Now, could you give us an example? So, for example, if we went through Allsop auction, now we're in the residential area, what type of property would be suitable for a bridging loan?
Yeah, so more often than not, someone going to auction is looking to buy a property for a good price. And if that property doesn't have a kitchen, doesn't have a bathroom, the decorating is dated, there's a leak somewhere, there's some damp in the property, they're going to get that property for a good price. But the downside is they're not going to get a mortgage on that property. So that's the kind of property that a bridge is required for, and during the period of that bridge you can either spend your own money to improve that property up to a habitable state, or you can borrow the money from a bridging lender to get that property into a condition where you can either sell it and keep the profit, or if you want to hold on to that property you can remortgage onto a long-term buy-to-let loan.
Now, bridging finance actually scares a lot of people. If you mention bridging finance to someone that's starting off new, I think it's been instilled from probably people sitting in the pub talking about bridging finance. That actually put some fear into some people. Obviously, being in the industry for close to 30 years, have you seen bridging finance change during that period? And if so, how?
Yeah, I have. I think probably the biggest change that I've personally seen over the last 13 years is price. That's a big thing. Price was always something that I think scared people. They looked at it and thought, it's like when you look at a credit, well, that's just it. People look at a credit card and they use credit cards on a daily basis. And credit cards actually charge more interest than a bridging loan. But because a bridging loan is perhaps sometimes looked at like a mortgage, people are wondering why it is they're paying 12, 13, 14% per annum when they can get an equivalent mortgage for 4, 5, 6% per annum. But you can't look at a bridging loan as the same basis as a mortgage, because a mortgage is designed to be held for multiple years. A bridging loan is only designed to be held for 6 to 12 months. So you're using a loan vehicle to take you from point A to point B for 12 months max. So if that costs you 12% to do that, then that's the appropriate vehicle to do because you can't get a mortgage. Having said that, the changes over the last 13 years, the price has come down where people have accepted that bridges are something that needs to be used on a regular basis. The price has come down with it. So when I first joined at Dragonfly, I think we were charging the equivalent of 1.15% a month. Now you can borrow from us from as little as 0.744% a month. So that for me is the biggest change. The more people understand, the more demand, the more competition, the lower the price comes.
Now, I can safely say probably over the last 18 months, I've seen a number of new bridging lenders come to the market. The rates actually differ and some of the propositions differ. Now, why does a bridging rate differ per month from company to company?
Yeah, it's a really good question. Obviously, what you'll have is two main differences between lenders in the market. You'll have a principal lender and you'll have a bank. Obviously, a bank, people are more familiar with. People invest with a bank. The bank use those investors' money to lend and they make their profit on the margin between what they're paying the investor to what they're charging the borrower. And that's how that business model works. That is very highly driven by bank-based rates because the rates that are being offered for savings and offering for borrowing are very much linked to bank-based rates. Then you'll get a principal lender, a lender like Octane Capital, where we lend our own money. So the money that we lend comes from the people that own the company. So what they charge for that is what they feel is appropriate to be as competitive as they can in the market, at the same time giving, a good return to their investors in turn. And so that's why you'll see that difference from one lender to the other. I would imagine that, those that are charging the cheapest rates are probably those with a very good lending structure internally from a principal lender's perspective, or maybe the banks, and those that are charging the higher interest rates are probably newer companies to the market where their investors are getting a feel for an understanding of the market and they will want a considerable return for their investment until they properly understand the risk.
The other thing I've noticed with bridging lenders is the maximum loan to value can vary lender to lender. Mm-hmm. What's the logic behind this?
Okay, again, that all comes down to risk. And what will happen is that risk between one lender and the next, and the next, and the next, and the next will be different. Some lenders will be comfortable lending at a higher leverage because they've got an extremely large loan book. And by that I mean it means they've got hundreds and hundreds and hundreds, if not thousands, of loans under management. Therefore, taking a risk on one loan makes a very small difference to the overall business model. As a smaller lender with a smaller loan book, making mistakes is something that you need to be more careful about, and mistakes can come from offering too high a leverage or too much risk than you can handle. So it will vary between lender to lender, and I think the main reason will be based on the size of that lender. Larger lenders with a larger loan book can afford to take higher risks, therefore they can afford to lend at a higher leverage.
Now we've noticed rates, especially the Bank of England rate, has actually increased significantly from a few years back. Now, has that had an impact on what you've seen in the market? So this could be in terms of the type of developments that are being undertaken and also with people struggling to exit bridging finance.
Okay, so again, really good question. In reality, for those people that are more my age, they'll appreciate that where rates are now is more really where they should be, more of an average. The younger generation, people more of your age, will have become very used to low, almost negative interest rates. When I took out my first mortgage, my interest rate was 15.5% per annum. Wow. And that was on a mortgage with a high street building society. So that probably puts into perspective bank-based rates at around 5% now, 5.25%, 5.5%, are at a level really where they should be. And that when they were at almost zero, that was excessively low for really a period of time that I think everybody began to enjoy. Did it make a difference to the market? Yes, of course it did, because when people have become used to low interest rates and they suddenly go from being 0.5% to 5.5%, yes, of course it makes a difference. Everybody's business models has to adjust to that. And the problem was, you go for a period of 10 and 15 years of low interest rates and rents generally will fall in line with the interest rate requirements. So if there's an increase, especially a significant increase in interest rates, all of a sudden rents won't cover those interest payments. And as you say, it makes it difficult for someone to exit a bridging loan onto a buy-to-let because perhaps the rent now can't cover the interest at that leverage. Another reason to consider the leverage that you're offering. You have to make sure that whatever leverage you're offering on the bridge is capable of being repaid at that same level on the exit loan on the buy-to-let. But what's happening is gradually the rental market is adjusting accordingly. People are beginning to move to HMOs, which generate a higher yield, or turning houses into flats to generate a higher yield. And those higher yields are how they are managing to meet the mortgage interest payments and making their exits more viable.
Valuation reports play a critical part, one for a borrower, one for a lender. Yep. Can you break down the significance of a commercial valuation?
Yeah, okay, so as you say, valuations really have a purpose for both the borrower and the lender. From the lender's perspective, they're looking for an impartial opinion on the value of the security upon which they are being asked to lend. And they would expect the valuer to be looking at local comparables, so properties of a similar size and nature within anything from in the same road to perhaps up to 5 miles away. And then on that basis, the lender is comfortable knowing that the loan that they're about to make shouldn't be deemed as higher than their risk appetite because they've had an independent valuer, tell them what their property's worth. Now, I think where there's a slight, not so much conflict, but where there's a difference of opinion, obviously the investor or the borrower's views are generally more optimistic than the valuer. The valuer is responsible for that valuation as PI insurance, so by his very nature will tend to be conservative. The investor would have done his research, he'll be looking at that valuation on a basis of it makes his project work for him at a given level. So, there sometimes can be not so much a conflict, but a difference in views in that situation. Coming on to the basis of valuation, again, that differs again from lender to lender, and again, is driven by attitude to risk. So whether a lender looking at an HMO in particular is looking at a commercial valuation or a bricks and mortar valuation, again, very much depends on what the investor, the borrower, is developing out. So if, for example, they're building an 8-bed HMO, they will require planning permission, sui generis, to get that. And I think any lender would agree that on that basis, that property should be valued on a commercial basis.
Now, obviously, you guys do the bridging finance, you don't do the exit finance. This is onto like some buy-to-let commercial loan basis. Now, if someone has a valuation report done with you guys for the purchase and what the GDV is, can they actually use that when moving across to an exit lender?
Absolutely, yeah. What we will try to do when working in conjunction with the broker, we'll discuss the valuation options with the broker. So we use a panel. There's generally a choice of 4 or 5 valuers to use. The chances are that there will be at least 1 or 2 of the valuers on that panel that do valuations for us for a bridge and do valuations for a buy-to-let lender for the exit. So if we use the valuer that is happy to report to both bridging lender and exit lender, it gives the borrower that element of security that their exit is safe, because they know that their exit lender can rely on the same valuation that we've used for the bridge.
No, that is actually a valid point, and it's something that we've been using, because I think just having that valuation, having the exit figures, takes away a lot of the anomalies about moving across somewhere else. And this is where, when looking on online forums, we see a lot of investors complaining about a valuer's messed up his exit valuation and now he's going to struggle to pay back investors or whatever. But it's a valid point for you guys at home to keep on top of. Now, we're at the start of 2025. I think everyone's reported it's been a strong start to the year. So HMRC actually reported January 2025 is 15% up in terms of transactions compared to 2024. Are you seeing that at the moment?
Yeah, we've seen at Octane. We've seen a very busy start to 2025. From a personal perspective, I certainly have. I've had people coming out of the woodwork saying that they want to get into the refurbishment market. So you know, the truth is that specialist finance brokers don't all necessarily focus in all areas of specialist finance. Some specialise in commercial property only. Some specialise in just doing the buy-to-lets only. Some finance brokers maybe just specialise in mortgages. But the reality is that there's been a very strong market in the development area of the market, or people converting properties, people using bridges, people using refurbishment loans. And I think we've seen already this year people coming out saying this is a part of the market that we want to get into, we want to start doing more of. Plus, of course, there's a little bit of optimism in the market at the moment, then hopefully there'll be, you know, a base rate reduction later this month, and I think if that happens, that will be a real boost to the end of the quarter.
Now, where do you see trends going for the rest of 2025?
What I'd like to see is more confidence in the market with regards to a steady base rate. I think if people's confidence starts to grow, then they will invest more frequently. As they invest more frequently, the market will move. If there's more new build development happening, especially for first and second time buyers, that in itself will create impetus, because those people will be looking to sell their properties that property investors will be looking to snap up. And I think if all of that continues, then there's no reason why 2025 can't be a strong year.
Thank you for that. I hope you guys enjoyed. Look, if you're new to the channel, make sure you hit that bell icon, subscribe, leave a comment. We'll be back again. We'll be doing some more collaborations with Octane later this year. We hope to see you there. We've got a free community. We've hit over 1,200 members. This is a platform where you guys can ask questions, we'll reply, and you've either got other people within the community that will actually help. Further details of this are in the description.